My name is Ted Dreyer. I am a lawyer at the law firm of Medoran Snyder and Kitchener. I am also a board member at the Council of Ontario Construction Associations, also known as COCA. COCA is a federation of 29 construction associations. Together, our members represent 10,000 general and trade contractors. Essentially, COCA is a lobby group for the construction industry at Queen's Park. COCA's top priority for many years has been the reform of the Construction Lien Act. Everybody knows that cash flow is critical in construction. However, delayed payments have become the norm in the construction industry. In 2015, Prompt Payment Ontario performed a survey of 535 trade contractors. They reported that their average receivable was 60 days overdue. 1 in 5 contractors had receivables that were an average of 90 days overdue. Half of trade contractors reported that they must wait over 90 days to receive their holdback. In a world of 30-day payment terms, where receivables are overdue by an average of 60 days, a 45-day deadline to register a claim for lien did not make much sense. The system needed reform. So I am happy to report that in December 2017, in a unanimous vote, the Ontario Legislature passed Bill 142, an act to amend the Construction Lien Act. COCA supported Bill 142 and believes it will benefit the construction industry. However, Bill 142 represents a major change. It will take you a while to learn the new rules. Today I'm going to address 6 topics: construction liens, construction trusts, adjudication, prompt payment, mandatory release of holdback, and mandatory bonding of public contracts. Different parts of Bill 142 will come into force at different times. The changes to construction liens, construction trusts, and holdbacks will go into effect on July 1st, 2018. The bigger changes involving prompt payment and adjudication will go into effect on October 1st, 2019. Once Bill 142 is proclaimed into force, what we have referred to as the Construction Lien Act will become known as the Construction Act. There are 3 major changes relating to construction liens that you need to know about. They are extending the deadline to register a construction lien, leading the interest of the landlord, and changes to the definition of substantial performance. The deadline to register a construction lien is being extended from 45 to 60 days for the trigger date. With one exception, Bill 142 doesn't change the trigger dates, but the running of the 45 and now 60-day period can be confusing. A quick review may be helpful. For subcontractors and anyone other than a general contractor, the deadline for filing a construction lien is 45 days from the earlier of the subcontractor's date of last supply or the publication of a certificate of substantial performance of the general contract in the Daily Commercial News. Currently, for general contractors, the deadline for filing a construction lien is 45 days from the earlier of the completion or abandonment of the general contract or the publication of a certificate of substantial performance of the general contract in the Daily Commercial News. Bill 142 does make one modification to the trigger dates. As of July 1st, the termination of the contract between the owner and the contractor will become a new triggering event that starts the running of the 60-day deadline to register a claim for lien for both contractors and subcontractors. Since a subcontractor or a sub-subcontractor will not necessarily know when the prime contract has been terminated, the Construction Act requires the owner and contractor to publish a notice of termination in the Daily Commercial News. The notice of termination will indicate the date upon which the prime contract was terminated, and that is the date from which the 60-day deadline to register a claim for lien will run, unless another triggering event has already occurred. That is my overview of the trigger dates for contractors and subcontractors. As I said, the headline is that as of the summer of 2018, the deadline for registering a claim for lien will extend from 45 to 60 days from the trigger date. But the details are more complicated than that. Even after the July 1st deadline is passed, whether you have 45 or 60 days to register a claim for lien will depend on various circumstances, such as the date the contract with the owner was signed and whether the contract arose out of a procurement process. Here's how the rules apply for a contract that does not arise out of a procurement process. The 45-day deadline will continue to apply to a contractor regardless of when the claim for lien is to be filed, if the contract with the owner was signed before July 1st, 2018. And the 45-day deadline to register a claim for lien will continue to apply to a subcontractor, regardless of when the lien is to be filed, and regardless of when the subcontract was signed, if the contract with the owner was signed before July 1st, 2018. Where the contract with the owner arose out of a procurement process, the transition rules are different. If the procurement process was initiated before July 1st, 2018, the 45-day deadline to register a claim for lien will continue to apply to any lien on that project, regardless of when the contract or subcontract was signed. If the owner issues a request for qualification, a request for proposals, or a call for tenders before July 1st, 2018, then the deadline to register a claim for lien for that project will be 45 days from the trigger date, regardless of when the contract or subcontract was signed. So the rules are complicated. Depending on the circumstances, your deadline to register a claim for lien may be 45 days from the trigger date, even after the July 1st deadline is passed. I think the takeaway here is that you should assume that the 45-day deadline applies to you, unless your lawyer tells you otherwise. Bill 142 will also make it easier for you to lien the interest of a landlord. Currently, if you're doing tenant fit-up work, in most cases you can only register a claim for lien against the interest of the tenant. That is generally a pointless exercise. If the tenant's lease is at or near the going market rate, then it has no value. There are exceptions, but in many cases the lien rights of people performing tenant fit-up work are worthless. Which is too bad, because it's not uncommon for tenants to run into financial difficulty as they are about to launch a new business. It is also unfair, because most leases are structured such that it is the landlord that is financing the cost of the work done for the tenant. Most leases provide that the landlord will pay the tenant a certain number of dollars per square foot to pay for the cost of tenant fit-up. We call that the tenant's improvements allowance. When Bill 142 comes into force, a contractor or subcontractor who is performing tenant fit-up work will be able to lien the interest of the landlord in the land. However, the landlord's exposure will be limited to 10% of the value of the tenant's improvements allowance. Performing tenant fit-up work will still be a risky proposition, but being able to lien the interest of a landlord will give lien claimants a little extra protection. Bill 142 will update the definition of substantial performance, which hasn't changed since 1983. The current definition provides that a contract is substantially complete when the improvement is ready for its intended use, and the cost of completing the contract is not more than 3% of the first $500,000 of the contract price, 2% of the next $500,000 of the contract price, and 1% of the balance of the contract price. Bill 142 effectively doubles the formula. So now a contract is substantially complete when the improvement is ready for its intended use, and the cost of completing the contract is not more than 3% of the first $1 million of the contract price, 2% of the next $1 million of the contract price, and 1% of the balance of the contract price. Admittedly, this is a small change, but one that will help you get your holdback a little faster. Our next topic are changes to construction trusts. Construction trusts have been part of the Construction Lien Act since 1983. Before I tell you about what has changed, I will tell you about what is staying the same. A construction project is like a pyramid. You have the owner at the top, the general contractor below the owner, and the subcontractors and suppliers below the general contractor, and so on and so forth. The purpose of all the trust provisions is that money at the top of the pyramid make its way down to the bottom of the pyramid. To accomplish that objective, the Construction Lien Act creates a trust at each level of the pyramid. The types of trust that concern us are the Contractor's Trust and the Subcontractor's Trust. The Contractor's Trust provides that any money received by a contractor from an owner is held in trust for the subcontractors on that project. The Subcontractor's Trust provides that any money received by a subcontractor from a contractor is held in trust for the subcontractors and suppliers of the subcontractor. Any other use of trust funds is a breach of trust. So, for example, if a contractor or subcontractor uses trust funds to pay overhead or to pay trades on other projects, then the contractor or subcontractor has breached the trust provisions. There are serious consequences for breaching the trust provisions. If a corporation violates the trust provisions, then the officers, directors, and people in control of the corporation are personally liable. Furthermore, that liability will often survive personal bankruptcy. Now, all of the trust rules that I've just described are already the law in Ontario, and nothing that I just described is going to change. The problem with the existing rules is that people are breaching the rules all the time. In theory, contractors and subcontractors are keeping trust funds isolated in separate accounts. In practice, we know that contractors and subcontractors typically have only one operating account. All of the trust funds from all their separate jobs get commingled together in that one account, and all their expenses from every job get paid from that same account. And it's from that same account from which the contractor or subcontractor pays all of its overhead expenses. And it's from that same account to which money flows back and forth from their line of credit. Once you commingle trust funds together that way, you cannot trace where money for any given payment came from, and that is a breach of the trust provisions. Even honest general contractors and subcontractors are sitting ducks for a trust claim. The new legislation will change the way contractors and subcontractors manage trust funds and keep their books relating to trust funds. We call this the New York model. The New York model will involve changes in the way you set up your bank accounts and changes in the way you keep your records relating to project funds. There is more than one way of setting up your bookkeeping and banking to comply with the New York model. Here's what I think will be the most common approach. Instead of having one bank account, you will have two. The first we will call your trust account. The second we will call your general account. All progress draws from all your projects will be deposited to your trust account, and all direct project costs, such as labor, material, and equipment from all your jobs will be paid from your trust account. You will not use your trust account to pay overhead expenses. Furthermore, money will not flow back and forth between your trust account and your line of credit, at least not directly. Next, you will have a general account. You will use your general account to pay all of your overhead expenses. Money will flow back and forth between your general account and your line of credit. So the first step in complying with the New York model is how you set up your bank accounts. The second step is keeping your books differently. As I said before, all progress draws from all of your jobs will go into the trust account, and all of your direct project costs from all of your jobs will be paid from your trust account. So you will still have a commingling of funds from different projects within your trust account. To address that commingling of funds, Bill 142 requires you to maintain a separate ledger for each project. So for each project you will have a ledger showing the trust funds received and the trust funds dispersed. When you tally up all of your ledgers together, you should be able to allocate all of the funds within your trust account among your different projects. If your trust funds allocated to a project exceed your payables for that project, then you can pay yourself by transferring the balance from your trust account to your general account. That is the New York model for managing trust funds. The New York model is a double-edged sword. On the one hand, if your ledgers balance, then you will have a defense to a trust claim even if you have commingled funds. On the other hand, if you fail to maintain your ledgers, or if your ledgers prove that you breached the trust funds, then the New York model will be your undoing. So far, we have talked about changes to construction liens and construction trusts. The next major reform is adjudication. When the Construction Act comes fully into effect on October 1st, 2019, any dispute between the parties to a construction contract involving the payment of money or the failure to pay money may be referred by either party to adjudication. Adjudication is dispute resolution that is fast, binding, and enforceable, but only on an interim basis. What does that mean? Adjudication is fast because the adjudicator must render a decision within 46 days of the date the dispute is referred to adjudication, or up to 60 days with the consent of both parties. Adjudication is binding because the decision of an adjudicator will have the same effect as an order of the court. Adjudication can be enforced in the same way that you can enforce a court order. You can seize and sell the debtor's assets. You may garnish their debts. In addition, if a contractor or subcontractor is not paid in accordance with the decision of an adjudicator, the contractor or subcontractor may suspend work until they are paid. Importantly, the decision of an adjudicator is only binding on an interim basis. The decision of an adjudicator is not the final word on the dispute. If a party does not like the outcome of an adjudication, they are free to go to court and relitigate the same issue all over again. Once the court renders a decision on the same issue, the decision of the adjudicator expires. Let's back up and take a closer look at the statutory right of suspension. If an adjudicator makes an order for the payment of money, and that money is not paid within 10 days, then the contractor or subcontractor may suspend work. The right of suspension lasts until they are paid the amount specified in the adjudicator's order, any accrued interest, and any reasonable costs incurred as a result of the suspension. An example of a cost that might be incurred would be the transportation of a piece of rental equipment back to the rental company. The qualifications to act as an adjudicator are contained in the regulations. The regulations say that anyone having 10 years of relevant construction experience who gets the training may qualify to act as an adjudicator. Relevant construction experience may include working as an accountant, architect, engineer, quantity surveyor, project manager, arbitrator, or lawyer. Bill 142 sets out the default rules for adjudication. However, Bill 142 allows the parties to add on to those rules in their contract, provided the changes don't conflict with the rules in the Act. For example, your contract may expand on the types of dispute that may be adjudicated, or it might extend the right of adjudication beyond the completion of the contract, or it might specify specific adjudication procedures, such as requiring all evidence to be given in person and under oath, or it might give the parties a right of cross-examination. So something for you to be on the lookout for in the fall of 2019 are clauses that modify the adjudication process. So far we have covered construction liens, construction trusts, and adjudication. Our next topic is prompt payment, and this is where things get complicated. Prompt payment is based on 5 general principles. The first general principle is that there are fixed timelines for payment that operate regardless of the terms of your contract. The triggering event for all the timelines is the delivery of a proper invoice by the contractor to the owner. Once a proper invoice is rendered by the contractor to the owner, that triggers a series of timelines for the flow of funds from the top of the pyramid down to the bottom. The next general principle is that the entire system operates on a pay-when-paid basis. If a contractor or subcontractor is not paid, then they do not have to pay their creditors on the project, subject to 2 conditions. The third general principle relates to notice. If an owner, contractor, or subcontractor intends not to pay an invoice or pay it in full, then they must give notice of their intent not to pay and specify the reasons why payment is not being made or made in full. The fourth general principle is that any dispute that disrupts the flow of funds must be referred to adjudication. So the system is pay when paid with a catch. If you don't pay, then you must give notice and you must adjudicate. The last general principle concerns the suspension of work. We have already touched on this earlier. If an adjudicator makes an order for payment and payment is not made within 10 days, then the contractor or subcontractor who is entitled to payment may suspend work. Before we look at the timelines for payment, let's pause and consider the contractor's invoicing of the owner in a little more detail. The owner and contractor are free to negotiate when the contractor may render invoices. If the contract is silent when the contractor may render invoices, the default rule is that invoices are to be rendered monthly. Since all of the timelines we are going to look at run from the date of the proper invoice rendered by the contractor to the owner, it will be important for everyone in the construction pyramid to know when the contractor renders its invoice. The Construction Act requires a contractor to advise a subcontractor or sub-subcontractor upon request of the date they render an invoice to the owner. Now, as I said, prompt payment has 5 general principles. I have developed 4 scenarios that illustrate these general principles and how they operate in different circumstances. The first scenario illustrates how the rules operate when funds are flowing smoothly. The triggering event is delivery of a proper invoice by the contractor to the owner. The owner must pay the contractor within 28 days of the date that the contractor renders a proper invoice to the owner. The contractor must pay their subcontractors within 7 days of the date they receive payment from the owner. Subcontractors must pay their sub-subcontractors and suppliers within 7 days of the date they receive payment from the contractor. In a perfect world, we would only need one scenario. But in the real world, there are disputes as between owners and contractors, contractors and subcontractors. The dispute may involve the value of the work done, whether the work was deficient, whether the payer has a back charge for damages, or whether liquidated damages apply because of delay. Scenario number 2 illustrates what happens when there is a dispute that disrupts the flow of funds. Again, the triggering event is the delivery of a proper invoice by the contractor to the owner. Within 14 days of the date that it receives a proper invoice from the contractor, the owner must deliver a notice of non-payment to the general contractor. The notice of non-payment must give details of the amount the owner intends to hold back and the reason why payment is not being made in full. A contractor has 7 days from the date that it receives a notice of non-payment from the owner to issue a notice of non-payment to its subcontractors. The notice of non-payment must specify the amount not being paid, provide a copy of the notice of non-payment received from the owner, and, here's the key, undertake to refer the dispute with the owner to adjudication within 21 days. Upon receipt of the notice of non-payment from the contractor, the subcontractor has 7 days to deliver notice of non-payment to its sub-subcontractors and suppliers. The difference is that the subcontractor does not need to refer the dispute to adjudication because the general contractor already has. The third scenario illustrates what happens when someone in the construction pyramid doesn't pay, even though they failed to deliver a notice of non-payment. Really, the steps are the same as in the second scenario, but the timelines are different. As in the other scenarios, the triggering event is the delivery of a proper invoice by the general contractor to the owner. In this scenario, the 28th day passes, but the owner does not make payment, even though it has not delivered a notice of non-payment. If the contractor does not want to pay its subs, it must deliver a notice of non-payment to them within 35 days of the date of its invoice to the owner, and undertake to adjudicate with the owner within 21 days. If it fails to do so, then it must pay the subcontractors even though it wasn't paid. For the sake of argument, let's assume that the general contractor doesn't send a notice to its subs and doesn't pay them either. Then its subcontractors have 42 days from the date that the general rendered its invoice to the owner to deliver a notice of non-payment to its sub-subcontractors and undertake to refer the dispute with the general contractor to adjudication. If the subcontractor fails to do so, then it must pay its sub-subcontractors even though it was not paid by the general contractor. In scenarios number 2 and 3, the owner paid the contractor nothing. In scenario number 4, let's assume that the owner pays 50% of the contractor's invoice. As you will see, scenario number 4 really just involves a combination of the rules we saw in scenarios 1, 2, and 3. As in scenario 1, to the extent that the contractor is paid by the owner, the general contractor has 7 days to pay their subcontractors, and the subcontractors have 7 days to pay their sub-subcontractors, and so on and so forth. Since there is a shortfall in funds, the tricky part is how you allocate the shortfall. I will come back to that later. But at least with respect to the timelines, scenario 4 is like scenario 1, to the extent that the owner pays the contractor. With respect to the 50% of the contractor's invoice that the owner does not intend to pay, scenario 4 is like scenario 2. The owner has 14 days from the date that it receives the proper invoice from the contractor to deliver a notice of non-payment regarding the 50% it intends not to pay. The general contractor has 7 days from the date that it receives notice of non-payment from the owner to give notice of non-payment to its subcontractors and undertake to refer the dispute with the owner to adjudication within 21 days. And the subcontractors have 7 days from the date that they receive notice of non-payment from the general contractor to give notice of non-payment to the sub-subs. If the owner short pays the general contractor without delivering a notice of non-payment, then the rules we saw in scenario 3 apply to the extent of the non-payment. If the general contractor does not want to make up the shortfall out of its own pocket, the general contractor has 35 days from the date that it rendered its invoice to the owner to deliver a notice of non-payment to the subcontractors and undertake to refer the dispute with the owner to adjudication within 21 days. If the general contractor short pays the subcontractors without giving them a notice of non-payment, then the subcontractors have 42 days to give notice of non-payment to their sub-subcontractors and undertake to refer the dispute with a general contractor to adjudication within 21 days. So far, scenario number 4 is really just a blend of the rules we saw in scenarios 1, 2, and 3. What is new is how you allocate the shortfall. If the owner doesn't specify why there is a shortfall in funds, then the funds received from the owner are to be distributed among the subcontractors on a ratable basis. In other words, the subcontractors get paid the same number of cents on the dollar. If the owner specifies that the reduction relates to the work of one particular subcontractor, then the other subcontractors get paid in full, and the subcontractor in question gets paid the balance. Our next topic is mandatory release of holdback. This is something of a gray area. Certainly, the statutory language concerning the release of holdbacks has changed in important ways. However, there are different theories as to what those changes mean. Currently, Section 26 of the Construction Lien Act provides that each payer upon the contract or a subcontract may, without jeopardy, pay the basic holdback where all liens that may be claimed against that holdback have expired or have been satisfied, discharged, or otherwise provided for under this Act. So the release of the basic holdback under the current Act is permissive but not mandatory. Most subcontracts, including the CCA1 standard form subcontract, provide that the holdback of a subcontractor is not payable until the work of the general contractor is substantially performed. So, as a practical matter, under the current language, subcontractors don't receive their holdbacks until the general contractor has received their holdback from the owner. Bill 142 replaces the word may with shall. So, as of July 1, 2018, Section 26 of the Construction Act provides as follows. Each payer upon the contract or a subcontract shall pay the basic holdback where all liens that may be claimed against that holdback have expired or have been satisfied, discharged, or otherwise provided for under this Act. There is more than one way of interpreting the new language. One interpretation is that the meaning of the word shall is clear, and that the general contractor has to pay the subcontractors their holdbacks as soon as the subcontractor's lien rights expire. That interpretation will be popular among early trades like excavators, who often wait months or years for the holdback under the current law. But it won't be popular among general contractors, who would need to finance the holdbacks of their subcontractors. General contractors will point out that the whole system of prompt payment operates on a pay-when-paid basis. They will say that it does not make sense for the system to operate on a pay-when-paid basis for the purpose of prompt payment, but not for the release of holdback. Now, resolving that debate is above my pay grade, and less may turn on the outcome of that debate than it may initially appear, because different rules apply as the project approaches substantial performance. For better or for worse, the principle of pay when paid clearly applies once the project has achieved substantial performance. If an owner does not intend to pay holdback, then, within 40 days of the publication of a certificate of substantial performance, an owner may publish a notice of non-payment in the Daily Commercial News, and, within 3 days of publication, provide a copy of the notice to the general contractor. If the notice of non-payment gets published, that will trigger the general contractor to deliver notice of non-payment to its subcontractors and refer the dispute with the owner to adjudication. Similar rules apply as between a subcontractor and their sub-subcontractors. The rationale for this process is that the publication of a notice of non-payment will signal to general contractors and subcontractors that they ought to consider exercising their lien rights. My last topic today concerns mandatory bonding of public contracts. When Bill 142 goes into effect, any public contract of $500,000 or more will need to be bonded. A public contract means a contract with the provincial crown, a municipality, or a broader public sector organization. A broader public sector organization means any school board, hospital, university, college of applied arts, Children's Aid Society, community health facility, or any organization that receives $10 million or more from the Ontario government in a given year. A contractor working on a public contract will need to post both a labor and material bond and a performance bond. Each of the bonds will need to cover 50% of the contract price. That is the end of the presentation. I would like to thank Glenn Ackerley of Weir Folds and Sandra Skivsky of the Ontario Masonry Contractors Association for their helpful comments. And I would like to thank Martin Benson of COCA and Michelle Henry Hayden of the Grand Valley Construction Association for their technical assistance. And lastly, I'd like to thank Sergei Sipovac for getting the ball rolling. Thank you very much.